Barry Burns here with TopDogTrading.com, and today we're going to be looking at the S&P 500. This is the S&P 500 going back to 1961, and the question before us is, has the market dynamic really changed a lot in recent years? A lot of people feel that it has, and therefore they feel that the old approach of buy and hold for investing is no longer valid because the market doesn't just keep going up, up, up endlessly as supposedly it used to do. So let's do a little historical research here and see where this comes from, and then we'll discuss it briefly. So you can certainly see where the buy and hold idea would come from, and from this principles like dollar cost averaging into the market. Basically, people who approach the market this way say that it's impossible to time the market perfectly, and therefore the point is just to get in because the market will go up over time given enough time. And we can see where this idea would come from. Again, this is a monthly chart to cover a lot of time here of the S&P 500, the benchmark. So we're going back to 62, and if you just look here, you can see market's definitely got an uptrend here. This covers 12 years. And then as we go forward, again, market continues to make, generally nice uptrend. Get a little bit of some sideways action here, but again, if you hold for a few years, boom, make some very, very nice gains. It's kind of funny to look back and see how see the price of the S&P way back then. And yeah, we would get some big bam smacks in the market here, some of these historical times that are well known. But then, market would continue up here, and then wow, look at that, boom, dramatic increase. Okay, and then we run into today's most recent market, the last 12 years. And here we see something very different, don't we? So basically what we've got is a channeling pattern. And over these 12 years, the market has not been going up. It has not made higher highs. It's still, in fact, we're still off of the highs of 2000. And so all of a sudden, people are looking at this and they're saying, wow. Now, timing is still an important part of the market, because even if you don't feel that you can time the market highs and lows perfectly, which I would agree, nobody can time them perfectly. If you're looking at long-term investing and you're looking for it with regard to your retirement, for example, when your retirement occurs is going to be an important part of your results. So, for example, if if you started investing here and we're here, you're okay. But if you brought money in here and then you retired 3 years later in 2003, and so now you're starting to take money out of the market, well, you lost money during this time. Of course, that's only a 3-year period. But some people, they don't invest in the stock market for decades. A lot of people, in fact, do not get an early start on their retirement accounts. And so they might only be in the market for, 10 years or so, 15 years. And here we've got, over 12 years of data where the market, net zero. So, and then the issue is, okay, when are you buying? Are you buying up here? How often do you buy? Buy here, buy here, buy here, but then you buy here, buy here, buy here. So you're basically, coming in somewhere around the average, and a lot of people are just saying, gosh, got to look elsewhere to make some good money. On the other hand, there really aren't a lot of other good low-risk situations, because the other situation people look toward are some sort of fixed income like bonds, but the interest rates are so dramatically low. Now, let's ask a question though. Okay, is this really that unusual? Well, it is pretty unusual. Again, if I just slowly scroll back, we can see that the market has generally been in an uptrend. But here, right in here, actually let me go all the way back. Okay. But right in here, we had a similar situation. It was slightly different in the sense that we actually had a megaphone pattern. So, the market made higher highs and lower lows. So this is a non-directional but increasingly volatile market. So a little different in that way, whereas basically now we're in a channel. We had a little bit of a lower low, but not much. It didn't break the highs. So, but still, here, basically, again, going forward, 12 years from 66 to 78, the market didn't have any gains. So this is not the first time this has happened. And the reason that I bring this up is because it's actually to be expected. The market has many different types of cycles. And we think of cycles generally as lows and highs, lows and highs, lows and highs. And that is definitely one type of cycle, those oscillations. There's also expansion-contraction cycles of volatility. There are calendar cycles, different times of the year, seasonal cycles. And then there's trending cycles, where the market trends and then stops trending, goes into a directional pattern, and then non-directional. And so what we're seeing here is, again, it is not the first time that this has happened. And so therefore, we are right now in a non-trending cycle. If we go back forward to our current market situation, market is just basically going sideways. We can go back a little further if we wanted to. And it's in a basic channel, pretty much equal highs and equal lows, minus the wicks. And after this, if history is any forecaster of what will happen in the future, then we might expect a trend to resume. So my only observation on this is that a couple of things. Number one, does not appear to me that the nature of the market, the fundamental nature of the market, has completely changed from any historical pattern. It seems to me just to be another non-trending cycle that we're in. We've seen it before, we're seeing it now. It does not mean that, some people say we've never seen this before. I don't agree with that. We have seen this before. However, it does also highlight the need for learning how to trade and how to invest, and as opposed to just throwing money at the market. I think education is a good thing. Education is always good. So to me, even though we can't always time every high and every low perfectly, that's for sure, we cannot. Still, with some good education, we can become more knowledgeable and make wiser decisions. And it's not easy. It does take a lot of time and effort and energy to do that. But it's worth it. It's your money, and it's important that you make those decisions. Or if you hire a professional money manager or somebody to work with you, that's fine, as long as they're qualified and they're good, they're qualified professional. But it's still your money. And so when you consult with a person like that, you should still be educated enough that you really understand what they're talking about, and you still have to make the final decision because you're responsible for the results that you're going to get, and most importantly, you're going to have to live with the results. So I do encourage everyone to get good financial education.